Hey, it's Darius. Scores are out, and congratulations to those who passed the CPA exam, and thanks for noticing the I-75 difference. So if you didn't pass, don't get mad. Get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. In this video, we're going to learn about life insurance premiums and whether they're deductible or not for tax purposes. And this is important if you're taking the CPA REG exam or the EA Part 2 exam. If a company pays insurance premiums to cover the lives of its employees, the deductibility of those expenses depends on the identity of the beneficiary of the life insurance policy. See, this is life insurance. It only pays out if somebody dies. If the company's the beneficiary of the policy, no tax deduction is allowed for the corporation because life insurance settlements are tax-free. The corporation would get the money tax-free, and the IRS, they wouldn't allow a deduction for something that'll never be taxable. But what if the company's not the beneficiary of the policy? They're making the premium payments, but let's say the employee can name their own beneficiary, then the cost is tax deductible to the corporation. For book purposes, financial statements, they write off that premium on the income statement regardless who the beneficiary is. That's an expense on the income statement. Doesn't matter if the company's the beneficiary or the family's the beneficiary. So this is one more expense that's handled differently for taxes than it is for books. So if net income's $100,000 on the financial statements, if that's book income, and they tell you that $5,000 was expensed for life insurance, and the company's the beneficiary, how much is taxable income? Well, as soon as you know that the company's the beneficiary, there's no deduction for the company because they're going to get the money one day when the employee dies, and when they get that money, it's tax-free, so the IRS won't give them a tax deduction. So even though they expensed the $5,000 on the income statement, you're going to have to add that back. So taxable income is 105 since the tax return does not allow a deduction for something like life insurance that will never be taxable. So let's say this was $1 million policy on some officer of the company. If the officer died and the company's the beneficiary, that means the corporation's going to get that $1 million policy when the officer dies, and that'll never be taxable because there's a special tax exemption afforded to life insurance settlements. So the IRS is not going to give a deduction for something that'll never be taxed. So if you had to reconcile from book income to taxable income and all you had was this information on the life insurance, you'd say book income's $100,000, add back a non-deductible expense of $5,000, and taxable income is $105,000. Company's paying for it, but they're not going to get a tax deduction because they're going to one day get this life insurance proceeds. However much the policy proceeds are. It could be $1 million policy, could be a $500,000 policy, whatever it is, the company's going to get it tax-free, so no deduction. Now, how would that change if the company was not the beneficiary? Well, that's the only thing we're going to change this time. Watch what happens. Net income's $100,000 on the financial statements. That's book income. But now they tell us $5,000 is expensed for life insurance, but the company is not the beneficiary. How much is taxable income? Well, since the company's not the beneficiary, the family of the officer will be the beneficiary, or someone will be, but not the company. So if the company's not the beneficiary, then the company is providing a benefit for someone else, and then the IRS says, take a tax deduction for that $5,000. Well, that $5,000 has already been expensed on the books, so we start with $100,000 of book income because of that $5,000 already being expensed, and we're not going to have to add it back. So taxable income is the same as book income, $100,000. You'll tell them that there's no difference between book income and taxable income when the company is not the beneficiary. Notice that the company got to expense on the books the $5,000 regardless of who the beneficiary was. All right, corporation had book income of $200,000. Deducted to arrive at book income was $5,000 to pay for the life insurance to cover the lives of key employees. The face amount of the policy, $500,000, gets paid to who? The corporation if the employee dies, not the family, but the corporation's the beneficiary. No employees died during the year. How much is taxable income for the corporation this year? We start with book income of $200,000. What do we do with that $5,000 expensed on the books to get us down to $200,000 of book income? Do we have to add it back? Yes, because this is a non-deductible expense since the money gets paid to the corporation if the employee dies. No tax deduction for the premiums each year. So the answer is $205,000 of taxable income. You'd reconcile from book income to taxable income like this. Book income of $200,000, add back a $5,000 non-deductible expense. Taxable income is $205,000. All because the company's the beneficiary. The money gets paid to the corporation if the employee died. Let's try this one. Corporation had book income of $200,000. Deducted to arrive at book income was $5,000 to pay for life insurance to cover the lives of key employees. The face amount of the policy, $500,000, gets paid to who? The family members this time of the employee who dies. No employees died during the year. How much is taxable income for the company for this year? And the answer is taxable income is $200,000, and so was book income. There's no adjustment needed. Since the $5,000 has already been deducted to arrive at book income, $200,000, and since the family members get the $500,000 when and if the employee dies, the company gets a tax deduction for the life insurance premiums paid each year because they're providing a benefit to someone other than themselves. They're providing a benefit to the family members. So in the end, there's no difference between book and taxable income because the company's not the beneficiary. If you were reconciling between book and taxable income, the $5,000 would not appear in the reconciliation. Let's try this. Harper Corp had book income of $200,000. Harper Corp paid life insurance premiums of $3,000, covering key employees for $300,000 of group term life insurance. So each employee was covered for $300,000, and it cost the company a total of $3,000 a year. Of these policies, 80% have proceeds that are payable to the employee's family. How much is taxable income for Harper Corp? So Harper can only deduct on the corporate tax return the premiums if they relate to policies where Harper Corp is not the beneficiary, but the employee's family is the beneficiary. So of these policies, 80% have proceeds payable to the family. That's good news. That means 80% of $3,000 or $2,400 can be deducted on the corporate tax return. But the other $600 has to be added back. So how much is taxable income? The answer is $200,600. Because when the life insurance policy benefits the employee's family, then the premiums paid by the corporation are deductible. The key aspect to distinguish is whether the policy is for the benefit of the company or the benefit of the employee's family. Since 80% of the $3,000 in premiums cover policies where the employee's family is the beneficiary, Harper Corp can deduct $2,400 of the premium payments. The remaining 20% of the premium payments are not deductible since those premiums cover policies where the corporation is the beneficiary. Now, all $3,000 has been expensed already on the books to arrive at $200,000 of book income, but the non-deductible portion, $600, must be added back, and that's why taxable income is $200,600. Answer choice D, because the question gave you book income of $200,000, and the key to the question was knowing that the $3,000 has already been expensed on the financial statements to arrive at the $200,000 of book income. And then it's just a matter of, can you leave that $3,000, all that $3,000 as a deduction, which means you don't have to add anything back? And if that were the case, taxable income would just be $200,000. Or do you have to add a portion of it back? And the only part that has to be added back is whatever's not deductible. And what's not deductible is the portion that relates to the company's benefit. And that would be the 20%. So you got to add back 20% of $3,000 or $600. And that's why taxable income is $200,600, letter D. And I can see them asking you a question just like this on the exam. All right, similar facts. Harper Corp had book income of $200,000. Harper Corp paid life insurance premiums of $3,000, covering key employees for $300,000 of group term life insurance. Of these policies, 80% have proceeds that are payable to the employee's family. So everything's the same so far. One employee died this year, and the $300,000 was paid to Harper Corp. So the corporation was the beneficiary from the policy of the employee who died this year. How much is taxable income for Harper Corp? If you think you know, leave me the answer in the comments section. And if you're struggling with the CPA exam or the EA exam and you found this video helpful and want to see the rest of it and more videos like it, get yourself on I-75 with me, Darius Clark. I'll leave a link in the description. I-75 is the only material that you'll need to pass the REG exam. So whether it's CPA, EA, or CMA, go to i75cpareview.com and get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference.